Well, it's time for your business news. OCBC's net profit hits an all-time high in the first half of this year. Second quarter results showing net profit shooting up 34% to 1.7 billion Sing dollars, lifted by higher income and insurance profit. The bank also announced a dividend of 40 cents per share. That's up 43% from last year. A net interest margin, now that's a key measure of profitability, is also up to 2.26%. And while OCBC expects this to continue, it's guarding against slowing global growth by increasing allowances on non-impaired assets. The bank says that's due to changes in risk profiles, especially in the commercial real estate sector in developed markets. While its loan books have gone up 2%, driven by more housing and corporate loans, it's expecting this loan momentum to stay slow.
We see low to mid-single-digit loan growth, potentially at the lower end. Global economic conditions to be softer indeed. We still see areas of opportunities for the loan book to advance: energy, power and utilities, inflation resistance, RE segments, for example, purpose-built student accommodation and hospitality, etc. Also in technology and digital infrastructure, that we see potential for growth.
OCBC's results round up the earnings season for Singapore banks. A quick comparison of the three shows DBS leading the pack with net profit jumping almost 50%, followed by OCBC, then UOB with a 27% rise. High interest rates also lifted net interest margins across the board, with all three seeing an increase in new money inflows. One analyst says fee income growth is likely to come down in the second half of this year, especially with more hikes expected from the US Federal Reserve.
One of the biggest effects of this higher interest rate, of course, is a double-edged sword. The first one being it will improve their NIMs, and we have seen that happening. But however, on the flip side, what this higher interest rates will do is that it will affect their loans growth. Going forward, this will definitely be a possibility for the banks where they will not see as much of loans growth for FY23 compared to FY22.